Welcome. In our continuing series on select items and key components of your business, we delve today into the world of liabilities, which looms large in your balance sheet, of course matched equally by the assets. Liabilities straddle the funds of both the internal and the external stakeholders. Internal refers to funds contributed or retained in the business by the entrepreneurs, promoters, shareholders, whereas external liabilities refer to borrowings from banks or institutions, credits or accommodation obtained from trade and other creditors, and any other form of accommodation from those who do not own the business. This presentation is about the special points which are integral to my approach when, as a meeting jockey, I review the financials of an organization, my client, in the company of those in the apex management. I believe that you will find these special points quite informative and educative. We move to the next slide. At a basic level, when you study the balance sheet, the liabilities reveal the sources from which the funds have been acquired for the business, whereas the assets reflect the deployment of such funds at a point in time. So the business starts with funding by the promoter or owner or the initial or later shareholders. These can be considered as internal or inside liabilities. These are visible on the face of the balance sheet as capital plus reserves, and also as loans or convertible instruments held by them, sometimes referred to as quasi-equity. With time, the long and short-term borrowings from outside parties are resorted to, as also trade credit availed by way of accounts payable, etc. These constitute what I said earlier was the outside liabilities. My first objective in the brainstorming session for evaluating the state of affairs of the business is to quickly ascertain whether the business is adequately funded. For me, it is imperative that I study the balance sheet in conjunction with the cash forecasts month-wise for the next 1 year. This gives me a fuller view of what are the present liquid resources by way of ready cash or bank balances, liquid investments, and other current assets by way of inventory, debtors, etc. The current and quick ratios are the key indicators of short-term solvency. Depending upon the industry, I look for a comfort level of 1.5 plus, which would indicate that I have at least 1.5 measure of current assets. Primarily, they refer to cash or inventory or debtors or accounts receivables, as you may say, and other liquid assets, as compared to 1 measure of current liability, which normally comprise payables and liabilities to be liquidated on demand or in the short run. The quick ratio is a tighter ratio in that it does not include inventory and prepaid expenses as an asset, and also bank overdraft or cash credit as a liability. These are considered as less liquid. I train my clients to be vigilant that it should be perched above the 1:1 threshold at least. Obviously, the liability side of your balance sheet gets perspective when you relate it to the asset side. You need to be guarded for a mismatch. It is preferable that the longer-term assets such as fixed assets or long-term trade or other investments and deposits are funded by the equity and a long-term debt, whereas the short or medium-term assets are funded by a combination of equity and maybe shorter-term debt. There has to be a match in terms of the tenure. Experience warns me about the possibility of a serious mismatch where short-term funds have funded long-term applications. In such a mismatched equation, the resultant cash squeeze is inevitable. The unbelievable travesty of a profitable company going bankrupt can happen as the business discovers that it does not have the funds to meet liabilities and function as a going concern. All this, believe me, despite being profitable, is possible. It is here that the cash forecast assumes paramount importance. Even as we evaluate the cash forecast, there is that lurking thought as to if the business faces a cash crunch in the coming months, where will the infusion of such cash to meet this contingency come from? This evaluation provides both the objectivity and the early warning which the company can heed to and plan effectively for the way ahead. We come to the next slide. Leverage refers to the amount of debt a firm uses to finance its assets and meet its liabilities. At times, the shareholders cannot, or for that matter, may consciously decide not to infuse equity anymore and take recourse to borrowed funds. Allied to leverage is the term gearing. Gearing refers to the relationship of a company's debt to equity. It shows to what extent the business operations are funded by lenders versus shareholders. It reflects the company's what we call as the financial leverage. How much to borrow or how much more to borrow is often the moot point of discussion in such brainstorming sessions. It is here that we invoke the two critical ratios. The debt-equity ratio, enshrined in the concept of gearing, varies again across industries and the regulatory provisions applicable to each geography. But higher the ratio, greater the financial leverage, greater the risk, especially if the chips are down. A debt equity of 2:1 would indicate 2 parts of debt to 1 part of equity, which looks alright as long as it does not threaten to leap significantly. However, I rely more on the proprietary ratio. The debt equity ratio in the definition of debt primarily considers the short and long-term debt and fixed payment liabilities and does not consider accounts payables and accrued or outstanding expenses, which can be substantial. The proprietary ratio considers all liabilities including trade payables. So you could have a company with a debt equity of 2:1 but a proprietary ratio of 6:1, which would indicate that the equity contribution is only 1 part as compared to 6 parts of the total outside liabilities. This indicates a heavy dependence on outside funding and financial accommodation and suggests a hint of overtrading. As financial experts, it becomes our bounden duty to raise a red flag if we feel that the risk is too threatening for the business, that the financial leverage has breached or threatens to breach the safety limits. A glance at the liabilities and the derived debt equity and proprietary ratio also tells you whether the financial structure looks over or undercapitalized. In normal scenarios, the rate of return on investment from the business is advantageously higher than the cost of borrowings, and it makes sense to resort to some level of borrowings, of course within the limits, to increase the returns for the shareholders. So much as reckless borrowing should be avoided, one need not be too conservative and risk-averse so as to avoid borrowings altogether. We come to the fourth and the final slide. A contingent liability can be defined as a liability that may or may not occur depending on the outcome of an uncertain future event. In the Management Information Report, I insist that the section on contingent liability is conspicuously highlighted and explained. There is that inherent danger that a threat which is actually crystallized gets camouflaged as a contingent liability. For instance, a huge demand by the statutory authorities which the management litigates but knows is actually a lost case can go unrecognized in the books and may inconspicuously languish in the notes stating the contingent liabilities. In the light of my experience, if I feel that the so-called contingent liability is almost certain to be incurred, for the sake of internal evaluation and during the brainstorming session, I ask for it to be considered as an expense and then compute the financial results accordingly. Very important to test the sensitivity. So friends, that brings us to the end of this presentation. Trust you will find this capsule useful. Thank you for watching this presentation.